Morning, guys. I'm not sure what EDM is, Paul. I'll have to Google that. All I think is electric disco music, but that's probably not it. Oh, electric dance music. I was close. I was close. I'm probably not an EDM guy anymore. Back when I was chasing girls in clubs, I could listen to it all night long. Good morning, everybody. Welcome to the room. I like it when we get off topic in here. It's kind of fun. And Ron, I don't disagree with you. That was hard to watch. And I'm sure there were millions of people that loved it. Man, that was hard to watch halftime. 80s headbanger. Still chase them, just can't remember why. And here we go. All right, guys. Good morning, Steve. Welcome everybody to the room. Big news today. 10 a.m. Fed Chair Powell is going to testify. Apparently, there is a biannual something that they talk about. I am dropping the link to Forex Factory. .com/calendar, and every morning I'm coming and I'm looking for this news. Every morning I'm coming in and I'm looking for high impact and medium impact news to make sure that I'm not trading into some sort of emotional response that could change the direction of the market, change the speed of the market, inhibit my ability to move stops and targets intelligently. So anytime I see a red box or an orange box, I choose not to trade. At 10 a.m., Fed Chair Powell testifies, so that's a big one. That could be a market mover. Tentatively, President Trump speaks. Anytime the president speaks, there's the potential for a reaction. So, understanding that around 10 a.m., guys, set an alarm. Have Siri remind you whatever it takes, but know that that's coming. And then everything that we talk about today, and this is for you newer folks, and for you older folks in case you need to go find answers, everything comes from the Nexgen page, guys, specifically the trading guide. Anything and everything that you need to be successful with the software will be laid before your feet this morning. You will not leave this room without every resource necessary to have a very consistent, profitable plan. And that's what we're going to focus on today. We're going to focus actually on the best of the best, the easiest, the highest probability. We're going to focus on, pardon the scroll, what we call a high probability trade this morning. A high probability trade is defined when each indicator on every chart agrees with the rules for the trade. Your triggers are going to be the absolute strongest. There's going to be no termination conditions in your way, just nothing between you and your target. We focus on this trade, and we do this every morning. First hour every morning is dedicated to understanding this trade because this is a trade that typically wins 70 to 80% of the time when you follow the rules. Everybody's goal coming into Nexgen is to see the potential to make $400 or $500 a day, right? Put ourselves in that six-figure income based on our trading. This is the trade that sets you up, that teaches you how to read your indicators, how to recognize advantages, and this is the one that's going to bring that confidence through the memory of success. Learning to read your charts is the first goal that we get out of this trade. I love making money. I love winning trades. It's exciting to be in the market, but I need to be in the market at the correct times. And the easiest way to do that is to be able to read your indicators, to be able to look at your charts and say, all right, it's giving me what I need to pull the trigger. Learning to read your charts is what this high probability trend trade does for you. It's only 3 rules. And once you get good at this chart reading, you're going to understand where the market is likely to continue. This becomes an entry for that highest probability trend trade. You're going to understand where the market is likely to go. It's going to help you with those targets, making sure that they make sense. And then finally, you will understand where the market is likely to stop. And these are those giant red flags waving in your face that say, hey, don't take that next trade. This is a great spot where the trend has the potential to end. We call those termination conditions. What you will find, I would say by the end of your first week is that about 90%, excuse me, allergy game is real here. About 90% of your day is spent reading indicators. 10% of your day is actually trading because advantages are present, because you see a pattern that you have proven wins more than it loses. So we're going to look at that first pattern that we talk about, the high probability trend trade. The market has a memory. It's pretty awesome. And it does the same thing over and over. And when you identify one of these patterns, you can describe it through the form of rules. And then you have this awesome option where anytime your rules are met, you know that it's a pattern that wins more than it loses. Zero hesitation, no conflict, you just get into that market. And then the same is true when your rules are not met. You're going to find it easier to sit on your hands, to be patient, to really embrace that 90%. So each rule for the high probability trend trade, there's only 3. When it's true, it creates an advantage. So strong trigger lines, rule number 1, will give the advantage of momentum. No termination conditions are going to give you a clear path. These two right here, momentum and clear path, are enough to build a trading plan that is both consistent and profitable. Rule number 3 is going to define your entry area. And defining that entry area is going to put you into the market where the market is most likely to continue. Rule number 3 is specific to trend trades. But I'm going to tell you, keep it very, very simple and learn momentum and path. And once you have these two, it's like blinders come off and you're going to see the opportunities in the market and the potential is just going to go up exponentially. These 3 rules happen on only 2 charts. We've gone to great lengths to simplify, to keep you from bringing all the extra noise in that isn't necessary. So we're going to let a large chart lead the way. It's a very big chart. It's a slow chart. It's difficult to see change on this chart, which is kind of nice because this large chart through the most current bar, the first bar printing, will define direction, momentum, and areas. And this very broad stroke of a brush, it's really showing the overall opinion of the market. Rule number 1, the advantage of momentum, comes from that first bar on the large chart. Rule number 2 will be true, defining the areas on your large chart. And only when these 2 rules are met are you going to turn your attention to a smaller, faster chart. This is your refinement chart. And your small chart is an entry chart. The entry chart is where you're going to pinpoint precisely where the market is most likely to continue. By using this refinement chart, you're going to be able to reduce risk, you're going to be able to increase profitability, and it really just gives an x-ray of that one bar. So this chart may say up, strong, nothing in the way, and you're going to see the fluctuations and the pullbacks on a smaller, faster chart and be able to use that refinement for an overwhelming amount of accuracy. We use these 2 charts. One of my favorite analogies, John Novak, get out of my room. I love you, big brother. Get out of my room. We're talking about charts and rules right now. Just kidding. It's his room. He can do whatever he wants. We're using these 2 charts because they really are. They're a reflection of who you're trading with and who you're trading against, guys. And the large chart is the large crowd. These are the men and women that create the trends. These are the men and women that establish momentum. These are the men and women that react at key areas. And the large chart is going to define which way you should be trading. The small chart is like the small crowd. And the small crowd is, these guys are fighters. They create little retracements, little pushes against everything that the large crowd wants. And we're going to use their fight, these retracements they create, to pinpoint precisely where the market is most likely to continue. This will become your entry for the highest probability trend trade. So we're going to take the next hour and we're going to learn the rules for when it's okay to trade. So for my newer users, Gary, Black Prince, who else do we have in here? I think we've got some new people. I want you to stay really hyper-focused on advantages initially. So we're going to learn those trigger line and Fibonacci rules for when it's okay to trade. You guys have the ability to simulate, to practice without fear of loss. But the first step in becoming a confident trader with the software is when you do simulate, when you have questions, take pictures, take lots of pictures. The same way John Novak takes a picture every time he enters a trade. Go through and post these in the room and talk about, he didn't annotate, I'll get on him for that. Talk about what you saw and why you did what you did and where you did it and where you got out. And what you'll find, and guys, this is the trade that we're talking about right now. He just took one live. What's going to happen is every time you post in my room, it becomes a private session. So we're going to talk about your chart read. You're going to do me the favor of talking about momentum. You're going to talk about whether or not you had a clear path. You're going to identify your entries and your exits. And every time you drop that picture in the room, we're going to go over your chart reads, and if there's anything I can give you to do it better, to do it more efficiently, to risk less, to make more, I'm going to give you that lesson right there in the moment. We will simplify. I'm going to put a trade plan in your hands that is 2 trades deep. That's it, just 2 trades. The first trade is the high probability trend trade, what we're talking about right now. The second trade is going to require you to have an understanding of the lessons that you learned in the high probability trend trade. It's going to require your chart reading. So you need to know what looks you're going to commit to. And you've got to learn these looks so that they become easy, because what happens is the more you recognize these patterns, the easier you're able to say to yourself, I have momentum. My path is clear. The slower the market appears to move and the easier it becomes to capture these moves. So the second part of becoming a confident trader ASAP is using the spreadsheet that Nexgen gives you. It's the same spreadsheet that I drop in this room every day. I'll do it right now. And this spreadsheet is going to help with repetition and recognition. So the first tab on the spreadsheet is your trade journal. This is where every time you post a trade in the class, you're going to drop it into your spreadsheet. You're going to talk about your advantages, and most importantly, you're going to drop in the feedback from class. Maybe you were early, maybe you were late, maybe you fought something, maybe it was perfect, but whatever it is, you're going to begin to see things repeat themselves here. The good will repeat themselves. That's what you'll focus on. The negatives, perhaps, trading in determination conditions, getting in too early. You're going to be able to see those, identify those patterns, and learn to avoid them, and we will learn how to fix them. There are links in here, how to annotate for the best feedback, making sure that you cover the 3 rules, how to paste into the spreadsheet, and even the capture software. You all have it. It's TechSmith Capture, but if you can't seem to find it, feel free to download it again. The second tab are the basic rules. It's momentum and path in green, and what it looks like to not have those rules met in red. I'm going to give you something to fill this out, a little drill for you to go through to become a chart reader even faster. There is the client trade section. This is where I've stolen about 400 pictures from you guys when you do great things with the software. So all of these pictures in the green become an awesome study tool for you to go back to look at, to identify the advantages on other people's charts and see what they're doing with it. There is the high probability trend trade sequences, both long and short. There's a very mechanical management beginner plan. You will get this plan written out. These are the pictures that accompany it. Ideas on how to manage, patterns that you're going to see. As you study the software and learn to read the software, you're going to begin to see more and more, and it's going to open doors for you. So your job is to go to the build your plan, and this is where you're going to take a lot of pictures. And you're going to fill this up with the looks that you're going to commit to, and you're going to learn how to manage your trades with a little bit of feedback in the class, and you're going to begin to see patterns. Start taking pictures of them, drop them in the classroom. Hey, what does it mean when I see this? I seem to see it all the time. Your goal every day should be at least 15 annotated pictures. There we go. Because 15 pictures a day is 300 pictures a month, and 300 pictures a month is 900 pictures by the end of like a 90-day study period. And the people that take the most pictures, the people that annotate the most pictures, those are the people that tend to get to where they want to be the fastest. So we're going to go back. We're going to talk about the rules. We're going to break them down individually. We're going to talk about how to study them. You guys have the ability to simulate. I encourage you, every time you take a trade, win, lose, or draw, drop it in the room for a little bit of feedback. The whole goal is that you understand what you're doing right and what you're doing wrong. And my whole goal is to give you that feedback and also give you a little bit of coaching to fix anything that needs fixing. Simplify. We're going to keep it super basic this morning. We're going to talk about that one trade, those 3 rules, and we're gonna look at them, and we're just gonna commit to looks and patterns so that they become easy. And by the end of this first hour, you will have everything that you need to be successful with the software. So let's talk about the indicators. What are we looking at? Trigger lines show up on every chart. There are small triggers and there are large triggers. Small triggers are fast moving averages. Large triggers are slow moving averages. Small triggers are solid lines. They're the faster of the two. Large triggers are dashed. We're going to use these trigger lines to establish momentum. We're going to use these trigger lines to recognize termination conditions. We're even going to use these trigger lines for entries. So know the difference between the two, and you'll be great. Dima, the answer is no in that case. And we'll talk about why when we get to termination conditions. You'll also see areas on every chart. You will see divergence highs and divergence lows. Just one second, guys. My brother was telling me how much he likes me and how he thinks I'm the best brother in the world. So I just wanted to thank him for that with a quick little message. Guys, areas are going to be on every chart as well. We're going to use areas on the large chart to define termination conditions. We're going to use areas on the small chart to define entries. So this is just the names, just naming them. There are divergence highs and lows. There's red Fibonacci resistance. There's blue Fibonacci support, yellow 1-to-1s, and there's also mid-bands. So depending on the chart and the rules that we're looking for, they'll have a different role. So we're going to break it down. We're going to use those indicators and we're going to recognize advantages, and we're going to turn these advantages into a trade. So everything starts on the large chart. Large chart leads the way. Large chart will define the direction of the market, let you know which way you should be trading, looking for rules to be met. Large chart will establish momentum through strong trigger lines. That's rule number 1, and that's giving us that first advantage. So we're going to let it define trend. And this is, remember, very basic, very focused. If the background on the large chart is green, the trend is up. We're looking for rules to be met for high probability trend trades long. If the background is red, the trend is down. We're looking for rules to be met for high probability trend trades short. And that's really that simple, guys. The trend is your friend. And in order to have strong triggers, in order to have that advantage of momentum, some colors have to match. So in an uptrend, strong triggers means that the small triggers are up. They're above the large triggers. There is space between the small and large. I want you to picture scissors that are opening up, ready to cut. And it's the space created between the two that lets me know that the odds are favorable for the market to continue up. It's that odds favorable momentum. You're going to see it annotated on charts, OFM. In a downtrend with that red background, small triggers below the large triggers, Everything is wide, angled to the downside. Then once again, those open scissors, the space between small and large lets me know that the odds are favorable for the market to continue down. So we're going to get that odds favorable momentum. That odds favorable momentum is going to give us, we'll talk about that in termination conditions. That odds favorable momentum is going to give us the push we need to go in the direction of that trend trade. That odds favorable momentum is what gives us the potential to break key areas. Odds favorable momentum will even cover up some of the mistakes that new users tend to make. So strong triggers is rule number one. You're going to see strong triggers and identify it on a large chart, and the S&P really put on a clinic here. Separation gives me strength, and it pushes down all the way until those small triggers work their way inside of the large triggers. This is what we call a weakening of the large triggers. When you weaken the large triggers, anything can happen up or down. The advantage of momentum is gone. The market turns, strong triggers once again, becoming weak, and that's where the reversal happens. So the difference between strong and weak is going to come to you in the phrase that you associate with it. Odds favorable, strong, weak, anything can happen. We're relying on advantages. So from the point of separation until the point of return, this is where you're going to be looking for your highest probability trend trade. This is where you are going to be seeking out on that smaller, faster chart, pinpointing that entry where the market is most likely to continue. On that large, slow chart, one bar, anytime price gets below the middle point of that bar, it looks like it sprouts a tail or a wick. These wicks are the pullback on the smaller, faster chart. You'll see these and you'll understand that these are potential long entries, and you'll be able to go back and use that as a study tool. In that downtrend with strong triggers, you'll see those pullbacks. Get in the habit of circling these tails, and then when we talk about entries, we'll go and look and we'll see how many of these actually come together and create that entry for the highest probability trend trade. So I love to ask for whys in the room, guys. Is everybody with me? Strength is just separation of triggers. It has nothing to do with price bars. It has nothing to do with areas. It has everything to do with the small triggers breaking away from the large. The scissors open, and when the scissors close, the advantage is over. This is probably the easiest lesson that you're ever going to get. I'm going to do this real quick. I want to take everything off because I want you guys to see it visually. Just for grins. And these are the pictures that we're going to take. These are the pictures that are going to help you get to where you want to be. Let me let that calculate real quick. And what I'll do... Oh, that's the S&P. I should have done that on crude oil. There we go. What you're going to be able to do is in this one picture, you're going to be able to identify strength, and you can go back and type something like scissors open, space between, and get used to that phrase, odds favorable momentum. And then the same thing down here, I'm going to use that call out button and I'm going to say scissors closed, weak, anything can happen. And this is how you begin to develop trust. And what you're going to see is that that's a potential short trade, and that's a potential short trade, potential long trade, potential long trade. So you're going to be able to identify these opportunities beginning with the momentum of the market. So rule number one in place. Now we have to make sure we have a clear path. We're looking for termination conditions. And termination condition is simply an area. It's a horizontal line on the large chart that can stop the market. On the large chart, each and every one of these areas is a place where the market may reverse, where a fight may happen, where untradeable bounces may occur. And I want you to think of it that these lines on the large chart are where the large crowd are most likely to make decisions, where the buyers may buy, where the sellers may sell. So when we look at termination conditions, it's that Fibonacci-based indicator that may reverse the market. And we're going to understand its potential based on a comparison of that area and those T3 trigger lines. So we're going to use red Fibonacci resistance and blue Fibonacci support, yellow 1-to-1s, a cyan divergence low line or a magenta divergence high line, any third divergence in the same area is the one that doesn't use one of those lines. And then Dima, this one was for you, the large chart mid-band, but only if the large triggers are a full bar away. So that mid-band doesn't behave as a termination condition unless the large chart triggers are a full bar away. And that's something that we call the gap theory. We'll look at it later on in the day. But if decisions are being made at these key areas, the first step in identifying a termination condition is allow price. Allow price to reach that area. So Dima, there are some small details. Once you get, I'm glad you said that. I'm thankful that you said that. Keep it very, very simple in the beginning. Look for momentum. And then we're about to do the recipe for termination conditions. Focus on these two really. And what happens is once you have those two, it's like every door opens up. It's like all the opportunities seem to present themselves. So to identify a termination condition, price reaches the area. The decision-making process gets set off for the large crowd. If price reaches resistance, all you have to do is ask, where are my triggers? If your triggers remain below resistance, resistance is a termination condition. It could create an untradeable bounce that pulls you out of a long position. There could be a fight between buyers and sellers at this key area. It could break and the market could just continue up, or it could reverse completely, creating what we call a strong top. When a no triggers through termination condition reverses the market, it's a strong top, and a strong top is the precursor to the highest probability trend trade you can take. It's also the precursor and rule number one for about 3 other trades that you'll grow into. But the idea is that when price reaches resistance and your triggers remain below, you'll never know what the reaction is going to be. So it's important that you sit on your hands, do nothing, and wait to see what that reaction is rather than try to predict it. If it reverses, it's a strong top. The market continues down. That blue line is the target right up until price reaches. And when price reaches Fibonacci support, all you have to ask is, where are my triggers? And if your triggers remain above, it could create an untradeable bounce. It could create a fight between buyers and sellers. It could reverse the market completely, become a strong bottom, or it could break. Once again, you're never going to know what the reaction is going to be. Rule number 2 is designed because more often than not, when price reaches an area and the triggers remain above or below, it's going to result in a loser. And that's how our rules came to be through decades of study and pictures. And this is the picture from right before Thanksgiving. 36 instances where rule number 2 wasn't met, and it would have resulted in a loser had you taken a trade into that area. 36 times. Only 6 times did the area break. So all we're doing is we're trading the odds here. Is it more likely to win or lose? Areas break all the time. So if it doesn't reverse, it's likely to break. And this is what it looks like when it breaks. First, price reaches the line. Resistance. All the triggers remain below. It's a termination condition. I instantly think to myself, wait a second. Let's see what the reaction is. If my small triggers, both lines, when we refer to the small and large triggers breaking an area, it's imperative that both lines of the small triggers smash through the area. If the large triggers are kind of lagging behind, they're still below. As long as I have odds favorable momentum, this area has the potential to break, and there's opportunities in that potential to break, but they have to be managed a little more assertively because the area is not broken yet. But once my small triggers and my large triggers get north of resistance, get above resistance, resistance is considered broken. And once resistance is considered broken, it begins to behave as support. My path is clear, rule number 2 is met, and rule number 2 will be met until I reach the next line. So going the other direction. First, it's a termination condition. Price reaches, triggers remain above. Every line you hit, guys, will be a termination condition. Sometimes it's a fraction of a second, it feels like, and other times it may be a termination condition for 10 to 15 minutes before it breaks. But if price reaches the area and the triggers remain above, it's okay to sit on your hands and do nothing. If the small triggers smash through and the large triggers are still above, as long as there's momentum, it has the potential to break. There's a lot of opportunities. This will probably be the majority of your trades. They just need to be managed a little more assertively because the area is not broken yet. But once small and large get below, the path is clear. And with that momentum, we're going to look for opportunity. We're going to look for entries on the smaller, faster chart. So termination, potential, and then broken. That's the process as an area breaks. There will be times when the areas are stacked where you say to yourself, man, I just can't seem to get a clear path. I want to be in a trade. I have momentum down, but I keep hitting blue fibs. Guys, this is 90% of your day. 90% of a trader's day is doing absolutely nothing, waiting for advantages, waiting for that pattern that's been proven to win more than it loses. It's okay to do nothing. The futures markets trade approximately, I don't know, what is it, 200 billion a day is what they say. It's a lot. It's a lot. And those billions every day mean that we don't have to be in every move. We don't have to be. Is it a trillion, Jen? Yeah, I think I confused myself. I'm a step off today. We don't have to be the first one in. Don't have to be the last person out. The idea is that with momentum and a clear path, you can capture that $300 to $500 a day in between the areas, trading from the areas, trading to the areas, instead of hoping areas break. And that's rule number 2. And then Dima, let me show you what it looks like when a mid-band is a termination condition. Let me pull this back up. I don't want to do it on the NASDAQ. So we've got, this is crude oil. And once again, guys, I think pictures are powerful. I really do. Because here price reached resistance and the triggers didn't break, and that's a termination condition. And here it only had the potential to break, and there was a giant untradeable bounce right into the 1 to the 1s, right into resistance, right back to support again, back to resistance, over and over, guys. These lines can ruin your good time. Dima, you see how price reached the mid-band here? And there was room for an entire bar before it hit those trigger lines. That's when the mid-band is a termination condition. And we call this little look, this is what we call the gap theory. So anytime price reaches a Fibonacci area and the triggers are a full bar away, the market is more likely to close the gap back to those triggers. Let's find it. There's another one right there. Price accelerates, hits the mid-band, hits the fib, the large triggers don't follow, and sure enough, it closes the gap back to those triggers. That's one of the gospel truths on these charts, is that price loves to close the gap to the triggers, and that's going to become important as we talk about our entries. So, large charts led the way. Large charts said that I have the advantage of momentum because of strong triggers. I have a clear path because there's no termination conditions. It's time to go to the smaller chart, the faster chart, the refinement chart. It's time to let that small crowd fight. And there's one instance where I will refuse to take that entry, even though my large chart has momentum, even though my large chart has a clear path. And that's if I go to my entry chart and I see 3 divergences in the same price range. 3 losses of momentum in the same price range. And what's happening here is my smaller, faster chart is showing me change that I can't see on that big slow chart. It's telling me that the market keeps trying to push down and it keeps losing momentum in that push. And 3 of these in the same price range may terminate the trend. It becomes more powerful if it has those weak triggers. The smalls are inside of the large. Learned this lesson from rule number 1. And it actually becomes even more powerful if the third divergence is higher than the previous from a low or lower than the previous from a high. It's a little head and shoulders pattern. You'll see 3 divergences on every time frame. You'll see it on the smallest time frame first, and that is the only time that having the rules met on the large chart will not result in looking for an entry on the small chart. But if my rules are met, there's not 3 divergences, I'm going to go to my entry rules. And my entry rules tell me that I'm going to use a limit order. That's the precision of this methodology. I'm going to use a limit order to buy or sell that pullback, that little push. I'll show you the picture. That little push that the small crowd creates, I'm going to buy or sell that pullback, and I'm going to do it at an area, and I'm going to insist that that area be inside of triggers. And we do that for the same reason the mid-band is a termination condition when the triggers are a full bar away. Price typically returns to the large triggers. It does it on both the large and the small charts. So on your entry chart, that faster chart, that refinement chart, you'll have the large triggers, the 5-1 large triggers. They're native to that chart. You'll use them with the smalls to define momentum. But you'll also have the large triggers from your large chart. And we call these synthetic. These are just the 13-2 large triggers. They have steps on them. And what the trigger lines are going to do for you in the entry process is they're going to define where the retracement is most likely to occur. How far that little push down is most likely to go. So this big white box represents where the retracement is most likely to happen. My first hour is really focused on the best of the best. So I'm going to show you the best trigger look to take the high probability trend trade. It's what we call favorable large triggers. Favorable large triggers mean that the large and the synthetic are overlapping, one on top of each other. Looks like 2 snakes riding piggyback. And all it's doing is it's defining where the retracement is most likely to occur. So the tighter they are, the more accuracy you have. And then when you put areas, fibs, midbands, or yellow 1-to-1s inside of those triggers, you're giving the market a place to bounce. You're giving it something to ricochet off of, to continue with the trend. And this will define where the small crowd is most likely to fail. So let's go through a little process here. Once the rules are met on the large chart, once the rules are met on the large chart, I need that fight to begin. I'm going to wait for a reversal bar. And you'll notice on the smaller, faster chart, I blocked out the large chart because we're done with it. On the smaller, faster chart, you should have momentum and you'll have a lot of up bars and everything will be screaming north. And you're going to wait for that reversal bar. You're going to wait for the fight. And it's counterintuitive to want to buy the market when it looks like it's going down. But everything we're doing for our entries is inside of that 1 bar with all the advantages on the large chart. So we're going to wait for the reversal bar, and we need to identify where this retracement is most likely to go. And price tends to return to the large triggers. So I have large triggers and I have synthetic triggers on my entry chart. So from the highest line of the triggers to the lowest line of the triggers, this is where the retracement's most likely to occur. And the tighter they are on top of one another, the smaller this area becomes. That does help with accuracy. But trigger lines don't create bounces. We're looking for areas within the triggers. We're looking for fibs. We're looking for mid-bands. We're looking for yellow 1-to-1s. And the key is that they are inside of that retracement zone. So the tighter the retracement zone is, the less room there is for this bounce. This smaller box, from the highest point of support to the lowest point of support inside the triggers, this defines precisely where our advantage lies, where the market is most likely to continue, where the small crowd is most likely to fail. You're going to be able to study this historically and develop the confidence to activate that limit order, to wait for the market to push down. And you're literally going to buy the market on its way down on that smaller, faster chart. and it's going to be about 2 ticks above the highest point of support, or if it's a short trade, 2 ticks below that lowest point of resistance, because your large chart has momentum and your large chart has nothing in the way, and we just don't expect that retracement to get the job done too deep. So you're going to wait 2 ticks above, and if the small crowd pushes, if that retracement hits your order, you'll be in a long position, and you'll be in this long position with the advantage of a market where the odds are favorable for it to continue in the direction of the trend. You have the advantage of nothing on your large chart to create that bounce, and you have the advantage of having entered where the market is most likely to continue with the uptrend. And guys, this is your highest probability trade. Learn the recipe for identifying where the market is most likely to continue. It begins with a reversal bar. Well, it begins with the rules met on the large chart, and then a reversal bar on the small chart. And the reversal bar is not your entry. It's going to have you identifying those triggers and where the retracement is most likely to occur. And then once you've identified those triggers, you're going to say to yourself, this isn't my entry. I need to find the areas within fibs, midbands, or yellow 1-to-1s. And you're going to create a window of opportunity from the highest point of support to the lowest point of support inside of favorable large triggers. And you're going to be able to say to yourself, anything outside of those triggers, anything beyond those triggers, on the wrong side of the triggers, this is not part of the entry window. This is actually where the market should not go. It's beyond the retracement point. It's beyond the areas inside that are most likely to create a bounce. In a short trade, market says down, momentum is down, path is clear. You're going to wait for an up bar, that reversal bar. It's not your entry. It's going to have you looking for triggers. These triggers define where the retracement is most likely to occur, but the area inside defines where it's most likely to bounce. Your job is to activate that limit order a couple ticks below. Anything beyond the triggers, on the wrong side of the triggers, above these areas, this is where the market should not go, and none of these lines are part of the entry equation. So by defining where the market is most likely to continue, you've given yourself the ability to understand where the market should not go. And this is going to pay dividends in management because your initial stops are placed where the market should not go. Generally 4 to 5 ticks above all the trigger lines and above the entry support or resistance areas. So classroom verbiage calls it the window of opportunity, right? Inside of the triggers. So your initial stop is 4 to 5 ticks beyond, where your advantage is gone, where the edge is no longer present. And anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. It's very much a cost of doing business. And then your stop will get hit every now and then. I want you to be okay. I want you to recognize that that's a part of trading. It's all right. Make sure that you're in the correct trades. Make sure that those advantages were present and commit to that best entry. More often than not, you'll get a confirmation bar or a reversal bar in the direction of your trade. This is actually going to redefine where the market should not go. And your new stop will be 2 ticks above or 2 ticks below. And it's not uncommon to see you guys take these amazing entries. And once you get that reversal bar, leaving maybe $30, $40 of risk per contract on a trade. And even if it loses beyond that, it's such an insignificant loss in the big picture that the accuracy makes it easier to find yourself positive each and every day. But you've got to learn the patterns. So we're going to look at these again. Strong triggers, clear path. When this is true on the large chart, the market's trading up here. And this is kind of the zone where you're like, give me the reversal bar. I'm waiting for the reversal bar. So the very top of this bar is the beginning of the pullback. And you'll notice that there's only about 8 ticks to get to trouble. And a lot of you are going to say to yourself, man, that's just not enough room. Why would I take a trade with only 8 tick potential? $80 potential on crude oil. It doesn't even make sense. And then you have to remember that your entries are coming from the areas inside of favorable large triggers. And suddenly, those 8 ticks turn into 38 ticks. That $80 potential turns into $380 potential. because you wait for the areas inside of favorable large triggers. So this circle on the tail, if it lines up with support inside of triggers, this is your pattern, and you're going to use this tool to go back historically and study to have zero anxiety, no adrenaline on the trade. You're just going back and recognizing patterns. Some very common things new users will do is they'll say, I'll see the picture in the room, but Mark, I hit a termination condition on my small chart. I can't take that trend trade. Guys, remember, areas are defined on the large chart. The only thing on a small chart that'll keep me out of this trade is 3 divergences in the same price range. Some of you will say, but Mark, my small triggers turn red. I don't have momentum anymore. And I have to remind you that momentum is defined on the large chart. And with all of this movement, it never blinked on that big slow chart. So don't be... Why do we need fibs on the small chart? Because entries, Dima, come from fibs, mid-bands, or yellow 1-to-1s inside of triggers on the small chart. That's what creates the bounce. So every time you're looking for an entry, you're going to say to yourself, price may bounce off of these areas inside of triggers when the rules are met over here. So it's that support Fibonacci area that helps. Let's go back to that large chart that we had. And this is crude oil. I think the NASDAQ or S&P had plenty. I want you guys to see this. This is just historical. I'm going to circle tails. And we're going to get a few of them in here. We'll just do 4. That's 1350, 1155. And I'm gonna make this chart a little smaller, and I'm gonna pull up my smaller, faster chart, and we're gonna scroll back and we're gonna start looking for those tails. So here's my first one, momentum, path, and it pulled right back to support inside of the triggers. Can you guys give me a Y? If you see that, oop. And there's the second one. Right to support right inside of the retracement zone. So guys, this is what we're learning right now. We're learning how to find this trade, how to recognize this pattern, how to put it together to create opportunity. If we back it up to the downtrend, right back to the mid band, to the 1-to-1s just below in the retracement zone, and this one never makes it out of the retracement zone either, but that second one with 3 divergences, maybe not the trade you're looking for. You might say to yourself, hey, my advantage is gone. I choose to skip this trade. But once you get through, and there's the live market, odds favorable, everything says up. Guys, it pulled right back to support inside of those triggers. And that's where your bounce happened. And that is the live market. And what you're looking at right now is 3 divergences in the same price range. Maybe that's not going to be your trade. So guys, this is the highest probability trend trade. This is what we talk about every day. There's NASDAQ, and NASDAQ is crazy. And this is crude oil. And there's one of those tails with the potential to break. And sure enough, it pulled back to the mid band right inside of that retracement zone. So I'm going to give you guys some tools to study right now. I'm going to give you Chart Reading 101. And Chart Reading 101, guys, the goal, my hope for everyone is that you learn to look at your large chart first, that you let the large chart lead the way, and identify momentum through strong triggers and identify path through the lack of termination conditions. This really is the core of your education, and understanding these two concepts is what's going to open the door for the other opportunities in the market. Understanding path and momentum is going to set you up to see more, to take more, to do more. So to get to where you want to be, one of the easiest ways to do it is start taking pictures, guys. Really get in the habit of taking a lot of pictures. I'm talking to Gary and Black Prince and Rob and all you guys that are learning these very basic concepts. Don't be afraid to not be in the market, because if you go back and you start taking these pictures of strength, 25 pictures of strength, you're never going to confuse strength with weakness. You're never going to take a trade without the advantage of momentum, thinking that it was weakness. So go through and take these pictures, but don't just take them. Annotate them. Take the time to create the correlation between what you see and what it means to you. Post them in your spreadsheet. Study them each day until you're confident. And then as you take those pictures, brand new users, I don't expect you to be great at this from day one. I'm giving you a high probability trend trade checklist sheet as well. This is entry rules for the highest probability trend trade. The first section has them defined. Is the market coming from a strong top or bottom? Your reminder is that you can take a high probability trend trade without a strong top or bottom. That strong top or bottom throws some warm fuzzies in there. It sets you up for the highest probability. And a strong top or bottom is a termination that reverses the market. Do you have momentum, or are you working with weakness? Know the difference. Is it a termination condition? Is it only the potential to break? Or is it a clear path? Know the difference, because when you speak to yourself in terms of advantages, when you talk about what's in favor or what's not in favor, you know whether or not you need to manage assertively, or if it's one of those trades where you're probably going to look to hold for the next area. And then defining your entry, knowing where your advantage is gone, knowing where to put your limit order. Guys, that's all we're doing. And then the second page is the actual checklist, just stacked on top of itself. You can print this out. You can use it as you trade during the day. You can use it during market replay. And nobody in the history of this checklist has ever done worse than 70%. We've had people test it, back test it over like 400 days. And I believe 83.2 is the number these engineers came up with. So this is the best of the best, the highest probability, guys. This is the one that's going to teach you to read your indicators. And now I'm going to give you a plan. And this plan is a stepping stone in your learning journey. The high probability trend trade is not your only trade. This is the one that opens the doors and opens your eyes to see the other trades. You love hearing that number? I still remember it. The gentleman's name was Grant, and he ran this thing. It was 400 days, and it was essentially the KISS plan, and he came up with 83%. Guys, this plan that I'm giving you right now is designed to optimize your chances of success with the high probability trend trade as a new user. I've had people get funded in those prop firms following this plan within their first 30 days with Nexgen, because it relies on simplicity. It's the best of the best. It optimizes your chances of success. And then through simulation, study, class feedback, continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Once you talk to yourself in terms of advantages, you're going to see, find, and do more. This isn't a shackle. This is a launching point. But there's two things you need to know before you sit down to trade not on simulator. And you need to know these like the back of your hand. Why will I enter a trade? Rules met should be the answer. And rules are just a description of a pattern that has been proven to win more than it loses. And if you verify and you trust this pattern, there's no reason to not consistently enter when the rules are true. Your rules are going to help remove the emotions, because you're going to realize that you don't have to know what happens next to be successful. You only have to focus on the execution of the plan. And why will you exit? Guys, exits are taken either at profit targets or when advantages that you had to enter the trade have gone away prior to that target being reached. For example, 3 divergences in the same price range may be a reason to exit a trade. Divergence on a 50-50 trade may be a reason to exit the trade. So define your entry. There's that list one more time. The same thing we've talked about for the last hour. Define your entry. Great entries create manageable trades. Great entries reduce risk. Not only from the entry point, but when there's nothing in the way, when the triggers are strong, you're already managing your risk long before you ever take that trade. Getting in at the area inside of favorable large triggers is the first step in your management plan. And then the KISS management plan, you got to do something with those grade entries. It's based on 2 contracts, and it's designed to help you understand and trust stop placement, as well as being focused on getting profits captured quickly. So this management plan is teaching you to trust that you can get paid, putting your stops in the right spot, not in the emotionally driven spot. So you will create your own management plan based on your ability reading the indicators. But until you do, your very management, if then plan, is dependent on getting in where the market is most likely to continue, 2 ticks below that lowest point of resistance in this trade. If entry is 2 ticks below resistance inside of triggers, then initial stop is 4 or 5 ticks beyond the triggers. This is where the market should not go. And you will know your risk before the trade is ever entered. And that's one of the cool things, because you can decide if you're willing to risk that much. If you say, well, 15 ticks is too much, I'll put it at 5, you're putting your stop right at an area inside of triggers. And you know that that's where the market may go and may bounce. So your initial stop is 4 to 5 ticks. Your targets are predefined in the KISS plan, $100 and $200. And at this point, there's nothing to do. The market is either going to stop you out, it happens, it's a part of it, or it's going to give you a reversal bar in the direction of your trade. It's going to confirm that the market is going down with momentum, with path, with direction, everything. So if a reversal bar prints in the direction of your trade, you will redefine where the market should not go. Your new stop is 2 ticks above that reversal bar. And you now have $30 of risk per contract in this trade. And that feels good. That is some low risk trade in the futures market. Your targets don't adjust. They're still 100 and 200. And once again, it's hands off the mouse. You're either going to get stopped out for a tiny little loss, whatever, or it's going to hit your first target. And if it goes to the first target and not your stop loss, 1 contract is removed and those funds go into your account, and you're going to have 1 contract remaining in this trade, and you're going to go break even. You're going to take 100% of the risk off of that trade, because you're learning to trust that when that large chart has momentum and a clear path, it's more likely to go down than up. So you're going to risk nothing. You've already been paid, and your second target's only at $200. So if it reaches that second target, instead of hitting your break even, you're out of the trade. The position is over, and you just made $300, guys. And there's a lot of people, when they come to futures trading, they're like, well, $300 really isn't that much money, Mark. I can't make much. I can't do much with that. Guys, $300 a day, if that's the best that you do, is a $75,000 year. Do that trade twice a day. It's $150. 3 of those, $250,000. So it's not necessarily all the trades, the biggest moves. It's the best trades. And learning how to get paid consistently, that's what reaches the long-term goal. Learning how to get paid consistently with the advantages, guys. And as you grow, learn, and understand more, the potential for higher rewards becomes evident. So once again, I'm going to drop in the room everything that you need. Even 1 trade for 300 more contracts would be great. So isn't that same $300 trade double your contracts with the exact same plan? It's 150. 1 trade. And that's where trade copiers come in. And one thing that my brother's been working on a lot with his programmers is you could take a $100 trade and you could do it on 10 different accounts with a trade copier, and every $100 in that one account is a $1,000 trade. Hell, you could shut it down and go play golf. But learn the rules. Learn the process. So I'm going to give you guys everything that you need to be successful. That was my promise. Big news in 2. Thank you. Here is the spreadsheet once again, so that you can track all your trades. But I'm also going to give you this zip file. It's called All You Need. And it really is. It's all you need. It is these daily goals. It is the KISS plan. It is the high probability trend trade checklist sheet. It is how to study to get to where you want to be. It is also the PowerPoint that I use to teach this room every day. Let's go to the S&P and see if news does anything, just for grins. It is literally everything that you need to be successful with the software. And what we've done is we've just gone through it pretty systematically. We've learned the rules for when it's okay to trade. You guys have the ability to simulate, to post in the room, to get feedback on everything that you see and do. 15 hours live every week. You have a spreadsheet now where you can simplify, learn these looks, commit them to memory. The only thing you need now is repetition. Just getting in there and trying to get the job done. Getting in there and taking these trades and practicing these trades and learning these looks. And creating that solid foundation that's going to carry you to the next trade. So as we get into, here goes that news. Ellie hates news. She likes to bark at it. As we get into the second hour, I'm going to remind you. She's fine. Dogs get excited.
Thunder.
The key to everything that we do is having a foundation, learning to be a chart reader, understand the basics, and then every day just compound a little bit. Get a little bit better each day. Don't try to reach the finish line before you lace up your shoes, guys. Let it be a process. So for you new users, I blanket with very conservative rules. That recognition of advantages. I give you a solid plan that optimizes the chances of success as you learn to read your indicators. So for you new users, termination conditions are bad, and no momentum is bad, and no areas inside of triggers are bad. And it's these blanket rules that increase the likelihood of success, and success creates confidence. So it's kind of a little safety net for you as a brand new user. But they're not always bad, and you're going to see it in the room in the second hour. You're going to see people trading into termination conditions. You're going to see people trading without momentum, and it doesn't mean that their trade is wrong. It's right for them. It's based on their ability to read the indicators. The more time you spend with the software, the more you're going to see, and this is what opens doors for you. If you learn the process that yields results, if you learn the pattern that's producing the results seem to follow, guys. And that's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades as a brand new user, but rather just the best trades, you can find an extraordinary level of success. I've seen it for years. The further you newer folks deviate from simple, the longer you tend to take to get comfortable with the very basic pattern recognition. So in the beginning, let it be very black and white, and you'll begin to see your shades of gray. Question everything. Doubt everything. I'm okay with that. I gave you a plan where you can actively prove me wrong and show me that these rules don't work by going back and studying them. And you'll be amazed. You'll be with me forever if you do that work. I want you to learn, but I want you to give yourself a little bit of grace because you are new, and it's okay to be new. And there's no reason for you to believe that you should know everything, just beginning the game. So keep that in mind as we go to the second hour. It wasn't huge, was it? Wasn't a giant move. I'm going to load my template back on. While that reloads, I am going to take 5 minutes, go stretch my leg, and then when I come back, guys, we're going to go through the second hour, and we're going to start looking at all the pictures that you guys have posted. The one thing that I ask, and just, I ask, I humbly on bended knee request that you talk about the momentum on your large chart when you show me a picture, that you talk about your path, and you show me where you get in as well as where you get out. Because what you're doing every time you post in this room is you're asking for help. You're saying, hey, Mark, is my chart read correct? Am I doing it right? Is my entry the most efficient, the lowest risk? Did my target make sense? And guys, I promise you, I will give you everything in my arsenal if you simply give me this picture. You're going to be tempted to not post because what if you're wrong? What if you made a mistake? What if the momentum wasn't great? Guys, that is the best time to post because it means that we're going to get everything fixed faster. People that hide trades, that hide losers, take longer to get to where they want to be because you don't get the coaching on how to fix those mistakes. Every trade will go back to momentum, path, and entry. No matter what kind of trades you show me, it will go back to momentum, clear path, and entry. So if you post in the room trading into a termination condition, I'm going to tell you, because this is an educational room, that you traded into a termination condition. I'm not going to tell you it's the wrong trade. So we'll go basics first, and then we'll go into how your chart read created a pretty awesome little scenario. So I'll be back in 5 minutes. Is anyone a believer in termination conditions? To the tick, ladies and gentlemen, Fibonacci resistance. And then DEMA, the mid-band is the termination condition because the large triggers are a full bar away. There's your example right there, DEMA, of the gap theory. When price reaches the mid-band and the large triggers are on the other side of the reversal bar marker, that's when I have to say, dag nabbit, this thing may create a bounce. All right, guys, I'll be back in about 5 minutes. Post them if you got them. Ask any questions that you have, and we're going to have an awesome second half to this classroom. We're going to get into it. Just a heads up, our second hour is going to be muted on YouTube. I apparently don't know how to work the mute button. Wayne, you are up. Let's see what you did, my friend. Odds favorable, momentum, clear path. So I think we're talking right here. Not quite odds favorable, definitely strong trending market. Pulls back to support. You get in late, but with all that room, easy to make some money. And I like your entry, Wayne, because one of the things that tends to be detrimental for you guys that trade these market flow charts is just getting in on the wrong side of those small triggers, those fast triggers. So your patience is good, and it's all this is your white bar trade. From a termination, there's your white bar, get in, and it's easy money to the first one, and then because it's late, break even doesn't make as much sense. And I don't know if that's something that you have to account into your plan, is where the market shouldn't go. Sometimes you got to eat that risk a little bit, or be willing to get stopped out. And you're willing to get stopped out because making lots of money and then break even, it works out. And then guys, here's a pretty good picture of odds favorable momentum, nothing in the way. Not sure how we got into this one. Most of you guys got in up here. But that's the look, momentum and path, and sure enough, the market goes down, right? So John took a chili dog. John took a chili dog, momentum and path. Jump in, get paid, momentum and path. We've talked about that once or twice. And then 830 was a fib. And sure enough, the fib stopped the market, and I'm not sure why my small chart fibs are not showing up on my large chart. Let's see if we can figure this out real quick. 34.5, 13.2, plot midband. It says it's plotting support and resistance. I don't know. I'm going to rerun my Ninja script and see what it does. So guys, we have a whole hour to talk about whatever you want to talk about. We have an hour to talk about momentum. We have an hour to talk about path. We have an hour to talk about any trades, any management, anything going on in your head that you'd like a little clarity on. And you've also got the creator of the software in here. And he is pretty good at answering questions too. Look at that. John Novak in the room. Right there. One, two, three divergences. Triggers rolling, off support. All right. Price reaches resistance. Large triggers were a full bar away. It closed the gap. Now we're waiting to see what it's going to do. Guys, we're just in a holding pattern. Waiting for the best of the best. Waiting for a market that's giving us the advantages. Good stuff. It's always awesome when John shows up in here. Just shows you what's coming, right? What's next? A lot of fun. I want to talk about the idea that rules. Guys, rules are the cornerstone for everything as a brand new user. Being able to look at your charts, read the indicators, and say to yourself, hey, my rules are met, my rules are not met, and then choosing to trade or choosing not to trade. And this was such a big concept. Nexgen's had a trading room for as long as I can remember. And there was a gentleman years ago, he's been with Nexgen pretty close to 20 years. He came up with this, 25 years now. And I think this is brilliant because everybody has the realization at some point. Jen, you had it pretty recently that rules are everything. That rules are what keep you out of trouble, and rules are what get you into these great trades. So one thing this gentleman did is he created a penalty box for when he violated his rules. Because even though his goal was 100% adherence, we don't always do it. But when you recognize that you're sliding outside of that box, it makes it easier to recover. So one of the things he did is he said if he misses a good entry, he's just going to stand up and walk away for a minute. He's not allowed to trade for a minute. And missing a good entry means not getting in at the area inside of favorable large triggers. John, you have it on PDF. I was just going to drop the picture in. Oh, there it is. Cool. So thank you for that. Entering late, 2 minutes. Exiting for no reason. We do this a lot in the beginning because, man, the adrenaline's overwhelming, right? Oh, I'm up $100. I better just jump out even though everything's finally starting to go my way. That was a 3 minutes. 3 minutes, no trading. No matter what happens in the market. Moving your stop to lock in profit in the middle of nowhere, 5 minutes. Exiting late, giving up most of the profit, 7 minutes. Trading against direction. Trading against an area. Trading against area and direction. Guys, all of these are common mistakes that most of us make or have made or continue to make. Learning how to police yourself. Learning how to recognize that you're going outside of where you should be. I did it this morning. I was talking with John Novak all morning. We're taking trades, and I took a long trade. And in the moment, I was convinced it was the right trade. And it ran me over so fast. And then I looked at my screen again, and I traded against an area. Should have been a 15-minute timeout, and it was. I actually went and made breakfast after that. I was like, well, that wasn't smart. That cost me money. I gave back everything I made on the other trade, and that was an avoidable loss. And this is designed to help you avoid avoidable losses. Crude oil, caught in a little indecision. NASDAQ, look at the scramble on the NASDAQ. Brah, that's crazy, right? Large chart says down, but the small chart or small triggers now say up. Large triggers are flat, divergence both ways. Pretty easy to recognize that things aren't doing everything, but the big picture says down. The big picture, the overall, the large crowd says down. And John says on that 50-50 look, virtually no risk to get to that 18 fib. And John, I've got to figure out, I need you to look at my charts. Why is my synthetic not printing over like that? Good stuff. All right, so I'm going to mute for a second because I'm about to get a message from my brother telling me to shut up and make them ask questions. So guys, if there's something that you want to talk about, post a picture, post a question. I'm going to go radio silence for a minute. How about this one? I love showing this picture. This is a fun one. Hey, Cab, take care. Great trading today. The experience versus time. Experience versus time. John says, too tough, I give up, break even. Sometimes you gotta, right? Always looks like fun in the beginning. No idea what I'm doing, but I'm going to keep doing it. We've all been there. And then we're brilliant. 30 days in, we have it all figured out. Haven't taken one picture or participated in class, but we have it all figured out. Now I'm going to take my wife's diamond ring fund, put it in the market. And that's where, after you lose $5,000, you realize you need to tighten up your plan more than you thought before you went live the first time. And guys, this classroom is designed to start right here, if that makes sense. This classroom, the way we teach at Nexgen, is designed to help you avoid a lot of the pitfalls that people commonly fall into as new traders. And we do it with those very simple recognition of advantages. We do it by giving you a plan to get to where you want to be, that's going to help eliminate a lot of those challenges. And that's when you start on the upslope. So good stuff. We should just give John the microphone, you think? Let's see if he remembers how to teach a class. You're not focused. You're posting in my room. I love it. If you can't give your brother grief, who can you give grief? What do you want to talk about, ladies and gentlemen? For those of you with siblings, you realize the banter doesn't stop just because you got old and gray. What can I cover for you? Can we talk about it? What do you want to talk about, Bob? How it's magical and it'll create winners out of losers? But it's not. So let me show you something. We don't even have to look at the ES, Bob. And I'm going to show you the most important thing. When you talk about market flow signals that will initiate entries when rules are true. So Bob, market flow is the last chart to go to. If your large chart isn't giving you the rules true, and really that's it. To become Gumby's brother? Oh, Cairo. To become Gumby's brother. Have fun with that, Steve. Greg B, I sure can. Give me just a minute and we'll take a look at it. We'll talk about it. So Bob, when we talk about market flow, I'm going to give you my 2 cents, and I'm not going to open up my S&P because it keeps crashing. I need to rebuild that workspace, and there's no reason to crash again here in the room. But I do have crude oil, and the premise is the same. And I'm going to give you the keys to the kingdom on beginning to use market flow. And you're going to love this. And I'm going to take everything off of this chart. I'm going to take off divergence. I'm even going to take off the market flow. I'm going to take off the fibs. And the only thing that I'm going to leave on this chart, Bob, is trigger lines. And you're thinking to yourself, well, Mark, why the hell would you do that? Because now it's not a market flow chart anymore. Now it's just an 8-range chart, right? So, Bob, the first way that I use market flow is I just confirm the momentum in a move. So if I'm looking for a short trade, I want odds favorable down. If I'm looking for a long trade, I want odds favorable up. And what it's doing is it's giving me a third chart's worth of, we just looked at that one, John. You are focused. So I'll confirm momentum first. So right now I've got strong triggers on my market flow chart. I've got strong triggers on my large chart. and I've got strong triggers on my small chart. But the one thing that I don't have, Bob, is I don't have a clear path on my large chart. I'm trying to figure out where to put that. There we go. So my rules aren't met, so market flow chart means absolutely nothing. Once we start to get into it and get to that area, I'll use that confirmation process. Does that make sense? So momentum first. And then once I have momentum, let me go to my 8 range chart. And if the triggers are wrong, you lose. And that is about as real as it gets. So then the next way, once I begin to trust that momentum and refuse to fight it, let's go through and take a look at different ways that we can use market flow. One of them is when there's odds favorable momentum on all 3 charts and nothing in the way. Buying HVA lines is a great way. That provides you another opportunity. When I've got a really solid termination condition, see if we can get one. The HVA trade presents itself, and you have to have a market flow chart for that. So here's a termination to the upside, which means no more longs, right? That's not broken, that's not broken, that's not broken, and that is a complete termination. If everything rolls here, and I get one of those pink HVA lines off that termination condition, there may be an opportunity to catch the short move. Maybe they're trying to get back to that fib. So initially, use momentum. After you use momentum, you'll be able to go through and start looking for the HVA trade when a termination condition stops the market. Later on in life, let's say I'm in a short trade and everything says down. There's a pattern on market flow where you get an up bar and then a down bar. Becomes a management opportunity in the middle of the move there. So you're going to kind of capitalize on just a simple look and turn that into a better look, and then turn it into a better look. When bars break above the HVA, it's usually going to the next fib. This is what we call the HVA breakout trade. But Bob, notice that it's odds favorable momentum, odds favorable momentum. It's just a momentum style trade using one of the products of market flow, breaking above and closing above that HVA line, and then taking that little snapback, that down and then up. So that's a later in life trade. So initially just momentum is what I would say. And then from there you just start growing. So there's your termination. Probably not going long, waiting for that next opportunity. And I know that's probably not really thorough, but you could talk about market flow charts and what everything means for 100 days. Or you could just focus on momentum first, right? So Bob, if I'm thinking, I really want to go long here, what does this chart say? Those fast triggers are against me. It's more likely to lose than win. But if I'm trading with those fast triggers, it's more likely to win. Kind of cool, right? That little indication. I think market flow talks people into trades they shouldn't take. So you always have to stick to those rules. But it also buys a level of patience where you start saying, man, these are going the wrong way. Even though I think I should be going long, that's just not right. Let me let this one slow down before I think about going the other direction. I love market flow. I can tell you it was hilarious. My brother gave me market flow in the very beginning and didn't give me any rules for it, which was probably mean as a brother trick. And it cracked me up because I would go long and then short and then long and then short and long and short, long, short, long, short. Oh, I won. long, short. And I think after the first day, I had like 130 trades, and I was at about a 5% win percentage. Because I believed that the market flow chart, every up and down was a trade. And I didn't tie it to my rules on the other charts. So this is one of those examples. Everything says up. I have momentum, but it's not a clear path. This says wait, and I'm not going to take it arbitrarily at an HVA because the rules aren't met. So maybe I say, I'll tell you what, if I get a signal on market flow, there it is, I'll take a shot at this trade. But if it gives me a down bar, I'll exit my position. And because they're fighting everything, it's probably going to give me a down bar, make me exit my position. Because I'm fighting triggers. I'm fighting termination conditions. Do you see how that works, Bob? It gives you a little less risk, but you still want rules to be made. I would expect that one to not work more often than it does work. John says, look, everybody, momentum, potential to break. Let's take a trade. All right, Greg. Sorry. Entry. All right, momentum trade. Didn't take this trade because of lower divergence in the fib. All right, so Greg, triggers get through the fib, not a strong top. And that's okay, right? But I think, if I'm not mistaken, the very first rule in that momentum style trade, and let's go to them because I don't want to misspeak. The very first rule in that momentum style trade is rule number 1, good top or bottom, no trigger lines beyond the Fibonacci area, tops or bottoms. The second rule is no termination conditions. So Greg, when we look at your picture, trigger lines get through the fib. And even if you're like, okay, you know what? Maybe it was overrun. Let me look for it. Do you see how you traded directly into Fibonacci support? Every trigger line was above. And you're on the right side of the triggers, not the momentum side of the triggers. So great management, quick profits, but you're giving up a lot of advantages in this particular trade. More than anything, you're giving up the idea. You just don't have anywhere to go because you've just reached Fibonacci support. Does that make sense? Without that fib there, all day long, right off the mid-band triggers, all that good stuff. And this is that room to profit target. So 100% awesome job on the management, and you know, probably not the worst idea to not take that trade directly into a termination condition that just had divergence, and then it doesn't look like they gave you much opportunity after to catch a trade, and that's just one of those, you got to say not my money. And then John comes in and he says, forget everything you know about termination conditions. If he sees strong triggers, he's willing to take a chance. So the progression, right? In this room, we try to keep it a little conservative. And let me expand on this. John says, I don't see termination conditions. And I think that's maybe a little fallacy. What he means when he says that is if I have strong triggers on both charts and I'm coming from a strong top, I'll trade into that line and manage if need be. So guys, there's a little translation, and I speak fluent John Novak. He's not saying he doesn't see termination conditions. He absolutely sees termination conditions. But he puts more weight. And that was overrun, Greg, because look, 4 divergences in the same price range. That was them telling you, hey, they overran a little bit. So he sees this great top. He sees wide triggers, and he says, you know what? I'll take a shot, and when I get back to here, I'll let the market tell me whether I need to hold on to this position or whether or not I need to exit because it's going to hold. Does that make sense? And I think that's a little more clear than I don't see terminations with a great top and wide trigs. It means I do see the challenge, and I'm willing to manage assertively at it. But because there's more advantages than disadvantages, I'm willing to take that trade and manage. And again, it all goes back to the dead horse I beat every day. When you know what you're up against, you know whether or not you need to manage assertively. You know whether or not you need to look for changes on that smaller, faster chart, telling you that it might not be the home run trade that you want it to be. All right, Miss Jen. Whoops, I think I skipped one. Hold on. Let me close both of them and hit the first one because I don't know which one was first. All right. Ridiculous trade. Odds favorable. I like this. 50-50 here, but 100% termination condition here. When price gets back above the mid-band, you take the trade. Stop is down, hopefully 2 ticks below. Woo! All the risks. It works out. And you got paid and closed the second. Should have got out at the term. Honestly, you were watching the room. It doesn't look like much fun. Just directly into the termination. So let's go back to what John says. From a great top or bottom, I don't see the termination with wide triggers, right? Not from a great top or bottom. You have to see that termination condition. And I think that you gotta bounce with that level of momentum for the retest, and you're absolutely right. What a great place to get paid. And then nothing more true has ever been said in this room. 18,989 reps, and you start to see things a bit more clearly than those with a few days. Amen. Which is one of the reasons in this room I never use the phrase "it's obvious." Because if you're brand new, it's not. If you're brand new, it's not obvious. How do you make it obvious? By keeping it simple first. By understanding 2 very basic concepts, momentum and path. And knowing that that's the core and the foundation for everything. And then you grow from it. Can't imagine John would have touched that trade. Keep practicing. It's okay to make a mistake. It's so okay to make a mistake. If my wife didn't make a mistake, she wouldn't have left him and found me. I'm just saying, mistakes work out sometimes, right? There's always something to learn. With that level of momentum, you got the retest. And that's it. What will you do? So let's go see what the market's doing. There's that termination condition again. Man, these things pop in, don't they? And now my triggers are rolling. I had that 3 divergences. The third one was higher. John Novak, are you already long off that great termination? No? That looks like a John Novak trade. And then Jen, they're still dancing. They are still dancing in that area. Decisions being made. Oh, you're watching the ES? Right on. John says, no shorts. See, you have fibs I don't have. Not going short into the termination. Fun stuff. What do you guys want to talk about? And see, John, I don't have that fib. And Boaz, are you in here? No. There's that Nexgen momentum style trade off the termination. Triggers roll, strong triggers. And now we have the termination. We have momentum. We're getting a pullback to an area. My small triggers are above the reversal bar marker. My first trouble is the divergence high. Second one is the fib. What do you guys think? Odds favorable, clear path, pull back to support. And guys, on the NASDAQ, if the small triggers are a full bar away, I get in at the area. When it gets back there, I can manage this trade, stop where the market shouldn't go, and they got me. There you go. Anything that wins 70 to 80% of the time is obligated to lose 20 to 30. And that's NASDAQ. When it happens quick. We're still up money. And then that termination's still working. What do you want to talk about, guys? There's the close on the correct side, giving you a fighting chance. A lot of squiggle. Oops, I think I'm about to crash. I'm about to crash. Boom, there it goes. So let's bring it back up. All right, I'm just gonna flap my gums. One of my favorites, Mark Douglas. Late Mark Douglas. Rest in peace. Brilliant, absolutely brilliant in terms of psychology and trading. I know John Novak worked with him a lot back in the day. And this is, I highlighted it, one of my favorite things. When you stop expecting to win every trade, it's when you start winning most of your trades. When you don't care about the result, and you care about the execution of the method, because it's the execution, it's the process that yields the results. My brother used to say this to me: I don't care what happens. I don't know what's going to happen. I don't care what's going to happen. If they want my money, they're going to have to come get it. And that was a reference to putting stops where the market shouldn't go. And I always thought, I'm not going to lie, sorry, John, I always thought he was full of crap. I thought, there's no way he doesn't care what happens. There's no way he doesn't care. And what I realized is that what he was telling me was that he trusts the process, that he's studied it, that he's practiced it. Have a good day, John. And eventually, when something's been proven to win more than it loses, you can't help but take the trade. And you know that it's going to lose now and then, so it doesn't do you any good to put that fear of loss in. And I always thought that was pretty profound. And Jen, you're 100% right. If you watch him repeatedly and listen to what he says, it starts to sink in. And when it starts to sink in, it really does. It shows up in your trading. Another good one is this is emotion-free trading. And emotion-free trading is just a book, and it's got one phrase in there that I think is super impactful. And it's, am I acting in my own best interest? Am I acting in my own best interest? Is trading into this termination condition acting in my own best interest? Is just jumping into the market without momentum acting in my own best interest? And if you start asking that questions, you start realizing that a lot of the times you can avoid trades that you shouldn't be in by really zooming in and focusing on those rules, because your rules have been proven to be in your own best interest, and you start to adhere to them and really focus on them. So there's another one. The one my brother told me that I had to read 30 times in 30 days. 7 Habits of a Highly Successful Trader. He's been handing this thing out for decades, and it still rings true. Just a little reading material if you guys are interested. I don't own them. I didn't write them. I like to read stuff though. I like to hear other people's thoughts on things, especially if they're different than mine, because I think that's how I get there. Being open, willing to think of something different. So if you come into this room and you're like, well, I already trade the futures. Well, you probably don't trade them well, or you wouldn't be here, right? Or you're looking to add something to it. So becoming a student is difficult for people. Becoming a student is challenging for a lot of people, especially when you've had a successful career, when you've moved forward in your life and you're used to being the one with the answers. Sometimes it's a little daunting to be the one with the questions. I love being a student though. All right, I'm talking my throat dry.